Welcome traders to this free course about supply and demand trading. My question to you is today, do you want to trade like the professionals? With my guidance and support you can learn how to trade supply and demand zones. You can take your trading to the next level and potentially increase your profits. It's a powerful and easy trading method, and in my opinion it's one of the best trading strategies you can use. Supply and demand trading. So let's get started. In this video I will explain how supply and demand trading works, how to find supply and demand zones, how to use these zones, and of course how to trade them. And I will make some more videos in this playlist, and in the next part I will show you how to use my supply and demand indicator to simplify this whole process and how you can find supply and demand zones in seconds. But in this free course and in this video today we will use the blank and naked charts, no indicator and all, to find supply and demand zones so that you can master this strategy. So, what are the advantages of supply and demand trading? It's very quickly learnable with a little practice. You will trade like the pros with just a few and easy to understand rules. You will get big targets, small stop losses and high win rates. It's very usable for people who have a job during the day. Of course, it's excellent for day trading if you have time and you are in front of your screen. But if you have a job during the day and you must plan your trades maybe the days before, it's a perfect system for you. It's suitable for all markets: Forex, stocks, US 30, the German DAX, crypto, metals and so on. Of course, it can be combined with existing trading methods, and if you have already a good trading method, supply and demand trading added on the top will increase your win rate. And the supply and demand trading will be an eye-opener to how Forex trading really works and what does drive the markets. Now we are on a naked chart. There is no indicator attached, and a naked chart can tell you a lot. We are on the pound dollar, we are on the hourly chart. Every candle is 1 hour. And let's see this area here. You will see that the price is doing not much. It's a little bit going up, a little bit down, but there is no big movement. This tells us that the buyers and the sellers agree this is a good price. We don't want to buy it, we don't want to sell it. The price is in balance. And suddenly you can see we get an imbalance here. We get big red candles. The price is going really fast down. Something happened. Maybe there were fundamental news about the pound. The pound got weaker, or we got fundamental news about the dollar, so the dollar got stronger. But something happened that the pros and the big movers of the market, like banks, institutional traders, decided to sell this pair. So there were no buyers who thought, yeah, this pair is worth buying it. No, there were a lot of sellers who decided to sell this pair. So what happened next? We had this massive drop. And then if you check this area, you can see price came back in balance. The buyers and sellers agree this is a good price. We have only a movement up, a bit down, a bit up, a bit down. So again, the price is now in balance. And then next, we get big green candles. So now the buyers thought, yes, it's okay to buy this pair. It's a good, cheap price. We want to step in and we buy this pair. And you can see after this, we get again a zone where the price is in agreement. You can see we get again balance after this big movement up. And now again, buyers and sellers think, yeah, it's okay. Price is good. We don't buy it, we don't sell it for hours, and then suddenly we get this big green candle. So the buyers stepped massively in and they thought, yes, it's a very good price to buy this pair. The sellers don't get any chance to sell this pair. The buyers exceeded the sellers. When price was in balance for a while, like here, and then suddenly we get a drop with big red candles like here, then we're talking of a supply zone. How we exactly define this zone, I show you later. When price was in balance for a while like here, and then suddenly we get big green candles in a good up movement, or like here, we are talking of a demand zone. There is demand for this pair. You'll see it very good here. We have again this balance for a while and then this big massive green candle. This creates a demand zone. The same how we exactly define this zone, I show you later. And we are very close now to our first trade examples, but to help you fully understand what's driving the markets, I'll switch for a minute to the real world. So let's meet Aiden. This is Aiden. He saw that the gaming computer he always wanted is on sale for a sensational $200. He bought it immediately. And this here is Noah. Noah missed that sensational offer. The cheap price is no longer valid. The gaming computer costs now $600. Noah is very sad, of course, now, because he wants this gaming computer so badly. Okay, let's see what two choices Noah now has. Here's dump Noah. Noah doesn't care about the high price. He just buys the computer for $600. 5 days later, Noah sees that the $100 offer is back. He's now even more pissed off than before. Okay, this is dump Noah. And here is smart Noah. Smart Noah waits patiently for the $100 offer to come back. Some days later, he finds the offer again and buys the computer for the same price Aiden did. This is smart Noah. And if you wonder now what Aiden and Noah has to do with our Forex trading, I show you this now. Let's look at this area again. We had this balance here and then this big green candle. You remember? This created here a demand zone. The buyers on the market thought, okay, this is such a good price that we step into a buy trade with big order volume. Mostly this was an institutional trader or more institutional traders who decided, yes, this is a really good price to buy this pair. Like I told you before, maybe there were some news about the pound or the dollar, and then the trading decision was there to buy with big order volume this pair. As retail traders, we can't move the market, like I told you, but the big players in the market can do. And so, let's say this was Aiden who decided to buy this pair for such a good price as an institutional trader, as a bank, for example. And then there are minor institutional traders and we as retail traders. And if we are smart, we say, okay, we want to have the same price as Aiden did, and we wait until price comes back and we get the same price for our buy order. And because the thing you saw with the computer in Aiden and Noah works exactly the same in the Forex market. The minor institutional traders want to step into the market for the same price as the big institutional traders. They don't open a buy trade here like the dump traders. They saw this green candle and more green candles are coming, and then they open here, for example, a buy trade, and then they wonder why the trade failed. If you are a smart trader, you wait to get the same price, and the minor institutional traders do patiently wait. Even the big players in the market do wait until they get the same price for this pair. But you have to be careful. This only is valid if the news about this pair are still good. If we get a change in the fundamental news and suddenly the price for this pair is not good anymore, it can fail such a demand zone. We will see this later. But let's say the price was very good, the fundamental news are very good, and we want to step into a buy trade, and we want to have, of course, the same cheap price. We don't pay more, we want to have the same cheap price. And for this we draw now our demand zone here. And we do this with a box here. And how do we trade this? If we look on this area where the price was in balance, you see that some candles have these spikes here. We have here a spike, and here's a spike, a candle, and here. And we normally draw our demand zone by that way that we catch the spikes on the upper and on the lower end here of our balance zone. So let's make this rectangle, and I adjusted this now. Let's do this. We have it covered here on the spikes up and down. You can see we covered this and this, and now we have to see that it begins here with this candle. It does okay, and so you can see we covered the upper spike, the lower spike of our balance zone, and now we draw this box into the future, and if the price comes back into our demand zone, we want to buy again this pair, because then we have the same cheap price. Let's do this. We go with our box here. Let's make sure that we covered again here the spikes. This is now our demand zone. We drawed it after we had this green candle and this balance zone before. And as you can see, price comes like magic exactly back to our demand zone. And now the rest of the traders who are smart step into the market with a buy trade too, because they want to have the same cheap price. And look what happens next. And you could do this trade and plan this trade days before, because here on November the 7th, we are very sure that we have a balance and here imbalance. So there was created a demand zone. We could easily draw this zone, and then 2 days later the price came back. We got the same price like the institutional traders who firstly created here this move, and then you can see a lot of more traders stepped into this because the price was again good. It was really good. More and more stepped in, and then we have here the explosion of this trade. Let's do another example. You can see clearly here the price was in balance. We have a little bit up and down moves, but the price is in balance, and suddenly something happened and we have imbalance now. You can see green candles going up, 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 up. So we have an imbalance in the market, and if we are dumb, we would maybe jump here into a buy trade around here, because we saw all these green candles and you think, yes, that is great. We open a buy trade, and then you can see maybe this trade failed. If we are smart, we want to have the same cheap price, of course. We don't open here or here or here a buy trade. No, we wait patiently that we get the same cheap price as the beginning of this up move here. And so let's draw again our demand zone, and you can see this here was around the balance zone. We have these spikes here and here, and so again we try to cover with our rectangle these spikes. So let's begin. Maybe around this, you can see we covered here this spike and this spike. This was already the first bigger green candle. I would not cover this spike again or two, because you then get a too big balance zone, and here already was no balance anymore. This was balance, tiny candles. This is a too big candle to cover in our demand zone. So we covered here these spikes here and this spike here, and now again we draw this into the future. Let's do this, and we have to be careful that we don't change the box here, that all is covered. And you can see like magic, the price comes back exactly on our demand zone, a sniper entry, and then we get again this explosion of this trade again. And this on a naked chart, we don't use any indicator. It's our own eye, with our own eyes we can see clearly what is going on in the market if we understand the concept of supply and demand and what is driving the markets. And by the way, the box should be like this, that we covered this little spike too, but you can see it's regardless if you had only covered here this, this spike here, and you miss this spike, it still works because you have mostly a little bit of range where it still works, okay? So, but really correct, it like this way, that we cover this little spike too, and then you get this sniper entry on such a zone here. And so the most easiest way to go into a trade with supply and demand would be to place here a buy order, and you can see it again here. We had the demand zone created here on November the 23rd, and we had then 7 days time to plan this trade. On November the 30th, it came back to our demand zone. Of course, you have to wait patiently. It's like with Noah and Aiden. He had to wait patiently that he gets the same price. But you see, if we jumped here, or would have jumped into a buy trade here or here, we are the dump traders, because then price is going down and we want to have the same price. And this is the easiest way to place here a buy order in a little bit below this demand zone, our stop loss. And then if you check this here with our tool, you can see we had a stop loss from around, let's say, 46 pips. But the move we get then from here, from our entry, is over 300, almost 400 pips. We can easily double our win to loss ratio if we have a stop loss of 46 pips. Let's say we go then for the double, so for 90 pips, for example, it would easily be possible. 90 pips is already here. And if you waited for the first retracement of this up move like here, you got over 100 pips, almost 150 pips. And this is what I told you at the beginning. It's a perfect trading method if you maybe only have once a day time to plan your trades. You do this maybe at the evening or before work. You check your charts, your pairs you want to trade. You look for such balance and imbalance. Then you draw your box, and all you have to do then is to place the buy order, the pending buy order, and you wait patiently. Of course, if from here to here you see that some really bad fundamental news coming in, let's say there are fundamental news which really makes the dollar strong and the pound very, very weak. So then it's not much likely that this trade could hold, because if the dollar gets suddenly very, very strong and the pound very, very weak because of some surprising news, then you would maybe remove this buy order. But still, the risk is not too much. You risk 40 pips, maybe 50 pips for a stop loss to get such a move. So even if the news are bad maybe and change, the fundamental information changed for this pair, you could try it with a lower lot size still to come into this demand trade. But you should check from time to time the fundamental news about the Forex pairs. For example, on Forex Factory, you get every day the news and what's going on. And if you see there are bad news for this pair, you maybe decide to remove this order. But normally you could go with it. The two examples we saw were on the hourly chart. Basically, supply and demand trading works on all time frames, but the higher time frames are better. Like with every trading method, normally the higher time frames are more stable. I'm here on the M15 chart now to show you another example. So the lowest time frame normally I go with supply and demand trading is M15, but my most used time frame is M30, H1 and H4, and even the daily time frame. I show you one, two examples for the daily time frame too, because in the daily time frame, of course, you have a bigger stop loss. So it depends a little bit how much money you have on your trading account. If you have a good filled trading account with maybe $2,000, $3,000, $4,000, $5,000, you can go with the higher time frames like the daily time frame. But with the normal trading accounts, I see a lot with $500, maybe $1,000, or even only $200. You would focus on the M15, M30, and mostly on the H1 time frame. But let's do an example for a demand trade on the M15. And if you look here on this chart and you ask yourself, is there any demand zone obvious seeing on this chart? You would have only one place, or there's only one place where you can say, yes, this is a obvious demand zone, because this move here and this balance and this imbalance you can't miss if you look on this chart. This is the only really clear demand zone we can see. Here was the balance, and because we are now on M15, of course, the spiky and the up and down move is a little bit higher and lower as on the H1 time frame. So M15 is a little bit noisier on the candles. You can see this, they are a little bit bigger, and so you have to focus a little bit more on the M15. So the balance zones are a little bit bigger on M15. Not every time, but very often. And you can see clearly that here kind of balance. The price was going up and down and up and down, a little bit noisy, but still balanced. So the buyers and sellers were in agreement. It's okay. It's a good price so far. We don't buy it. We don't sell it. And then suddenly something happened on August the 23rd. And then suddenly we get these green candles. So we have imbalance here. Imbalance, and we had balance before. And so we can again draw our demand zone here with our rectangle tool, and now we have to cover the spikes, and we get of course a bigger box. We have here a big spike. Maybe you want only to take these spikes, but this is also a really interesting spike here. I would most probably cover this spike from here to here. So we draw the box from this lower spike to this higher spike, and let's do this here. We draw our box, and now we have to adjust this box a little bit. Let's do it like this, and we cover the lower spike too. So we covered here this spike, the high spike and the low spike, and now we do the same. We go with this box into our future prediction here, and let's see if this trade had worked. Make sure that we cover still the spikes. If we do this, you can see we covered this and this, and again price came down. It's a little bit more noisy. We are on an M15, remember, and then you can see it. This demand zone holds, and the trade is going more up. Of course, on the M15 you can't expect trades with 100 pips or so, so you have to go for a lower target. And let's see if we placed here our buy entry. Then we had a max of around almost 80 pips was the max for this move. So on the M15 I would go for 20, 30, maybe 40 pips. It depends a little bit how strong the market is on such a day, but you can't go normally on M15 for trades with 100 or more pips. This is more for the hourly time frame. So remember, on the lower time frames it still works. It's more noisy, like you can see, but still we can get 20, 30, maybe 40 pips out of such a nice supply and demand trade. This was a demand trade, of course. We had a demand zone, and you see the lower time frames do the same. Before we go further, I want to show you something with these boxes. If you want to modify such a box, for example to make it bigger or smaller, you can see that there is no possibility, there is no way to change this box, and if you click on it you don't get any possibility to make it bigger or smaller. That you can modify such a box on MT4, you have to double click on the edges of the box, like here. You make a double click on it and then you get these points here at the edges, and then you can make it bigger or you can draw it here and here like you want to do it. Okay, so this is the way to change such boxes, and then you can easily draw the boxes on your chart. And now we check the same for supply zones or supply trades. Remember, we need a balance and a drop. Then we have a supply zone. Like here, you can see the price was in balance all the time here, and then suddenly we get here this big drop downwards. So we have imbalance here. This was balance, imbalance. And we do the same. Now we look here for the candles with the spikes, and we make a box that we cover these spikes before this imbalance happened. And so let's do this. Mostly I would say we cover here these spikes, these two spikes, up to here this high. Let's make firstly a box, and let's adjust again here this box. Let's cover the spikes. You can see we covered here this spike, and on the highs we also cover here this, or if you only want to go here with this, it's also okay. It only depends how big is your stop loss. So it looks a little bit ugly here. I would go here with this box like that we cover here the complete candle too, but this is really only fine-tuning, because the important thing is, of course, the lower end of this box, because this defines our entry for such a supply trade, and the upper end of our rectangle defines where our stop loss sits at the end. Okay, so this would be our supply box or supply zone, and now we draw it into the future. Make sure that the box still fits with the wicks here. You can see it, and it's the same like you saw before. The price came back into our supply zone, and then we get this nice drop again here. So this was also a very easy trade. You saw it here on September the 20th. Here, or better to say, on 1 day later, we saw the imbalance, and the trade itself happened then 1 day later. So you had 1 day time to plan this trade, to place here, for example, a pending sell order. You place your stop loss here, and then you go here with this trade. We had here a stop loss. We are on the hourly time frame. We had here a stop loss from around 30 pips. And we had then here, if we had here placed a sell order, a max so far from over 130 pips. So if you maybe stopped here around after it began again a little to make a balance here, then you had almost 70 pips. So a really good win ratio here for this supply trade. And as you can see, it's the same like for the demand zones, only in the opposite direction, but we do exactly the same with our supply box, and the market did the same. It came back into this zone, and then more sellers opened trades, want to come with the same price in such a sell trade. You want, of course, if you sell, you want to sell it on a high price that you get max out of it. It's the opposite like on the demand zone. On the demand zone you want a really cheap price, and on the opposite direction, so on the supply zone, you want to jump in for a very high price if you expect a drop, because the higher the price and the bigger the drop, the more profit you will make, of course. Let's do another example for a supply trade. We are here on the hourly time frame and on the CAT Swissy. You can see here, for example, we have a drop, and let's look if we had a balance before, and yes, the price was here in balance before. You can see this clearly. We have tiny candles, we have some spikes on it, so buyers and sellers are in agreement. There's nothing to do. We stay on this price, and then suddenly we have here this drop with these 3 red candles. So we have here the balance and here the imbalance, and so we can again draw our box. The question is now, if we would cover here for our box this candle too. I would not cover it because the clear balance is around here. This one I would cover this spike, of course. This is a really tiny candle. Watch out for these tiny candles, these pin bars with the wicks on it. So I would cover here only this lower wick, and of course here this higher wicks here. So we draw here again our box here, and then we adjust this box here. Like I told you, we cover here this wick. So let's say it began around here, that we had the balance. Where you begin is not so important. Important is that you cover all the wicks. So, and we of course want to cover here this 2 wicks and this wick, and then we would draw this box into the future. So if we had seen this on this day, on September the 15th, we saw this clear drop, this balance before, and then we would have drawn this box into the future. And let's see the outcome. Let's make sure that we cover again our wicks. You can see it covered the lower wick and the higher wick, and this is a really good sniper entry we had here. Would you agree? And you can see this impressive green candle where it wants really to come back into the supply zone. You can see the market wants to come back into this zone. It's get pushed into this zone, and only a little bit it comes in this zone, and it begins suddenly to spike again and goes down. And here you can see this is really amazing, this magic of supply demand trading, that you can predict the market movement even days before. And here this was September the 15th, and you can see 7 days later then this trade happened. You could easily place here your sell order, the stop loss above, and then let's see what was the outcome. We had here a max of around 100 pips, and the stop loss in this case would have been, let's see, only 16 pips. 16 pips, a stop loss with 16 pips would have given you the chance for 100 pips. And if you have a stop loss of 16 pips and you want only double the target, you only need a little bit more than 30 pips if you want a ratio from 1 to 2. So let's say we would go for 30 pips from here, then here is our target 1 maybe, and then you make a target 2 at 60 pips. Yeah, checked. And then you make a target 3 of, say, 90 or 100 pips. Checked. Very nice. And you can see it's very easy, and you can plan it days before. Here's another chance on the same pair, the same time frame. Some weeks later, here on October the 4th, you can see again we have here a drop, a really impressive drop here. And before we had a balance. It's a little bit more noisy, the balance, maybe even we are on the H1, but still you can see it goes up and down, up and down. We have some spikes here. This is always important that you see in the balance zone spiky candles, pin bars, and then you get suddenly this drop. More impressive is here we had this really strong up move, and then some hours of balance, and then suddenly the imbalance in the opposite direction. This is very good, a good sign that maybe we reached here a point where the price is so high that the sellers decided to go into the market to sell this pair. And so in this case it's a little bit noisier, but still we can go here with a supply zone. I would cover in this case this lower wick here, and I would go here to this high for the stop loss in case that we have some stop hunts and that we are safe. So this is the lowest wick I can see here in the balance zone, and here the high. Maybe you could also go with this one here, but the balance begins more or less here with these tiny candles. These are bigger candles. If you see the start of these tiny candles, these pin bars, this is normally where the balance zone begins. But you would do no mistake if you would place the rectangle from here to here, but I go here with this wick. So let's do this. We draw our box again. See, we want to cover here this wick here. Let's say we start here from here to here, and then we can on this day already draw this box into the future, and then let's see what happened. Let's make the box correct. You can see the price came back into our supply zone. It went then down again for max around 70 pips here in this case. So it's always good to make maybe 2 or 3 targets if you want to have. So you could make here in this case, let's see what was the stop loss for this trade. It's a bigger one. Maybe you would filter out such trades if you say it's for me too big. We have here a stop loss of 30 pips. It's okay in my opinion, a 30 pip stop loss. If it's too big for you, you can easily skip it, of course. And you can see with 30 pips we were able here to make here 70 pips. So if you doubled again the target based on the 30 pip stop loss, you would go for 60 pips if you double it, and then you had reached this target around here. And then you make maybe a second target for 100 pips or so, but you can see then you had no chance again that you get the full 100 pips. It's not every time the same. Don't expect that every supply and demand trade gives you hundreds of pips. You should go with a target 1, a target 2 maybe, and of course if target 1 has been reached, you have to secure the trade, maybe by placing then here a break-even stop loss, or what you also can do in such a case, that you move your stop loss step by step. So say we opened here our sell trade. In the moment the candles came back to our zone, and then you could place your stop loss candle by candle. So we are here now in profit, and then we say now we place the stop loss here. Then price goes down and down. Then maybe we move it to here, and it still goes down. Then maybe you place it here, and then after that the trade was over and reached our stop loss. So you can do this too, that you check from time to time your trade, and then you move the stop loss behind your price with a little bit distance, and then you can wait how long it goes. I promised you to show you example on the daily time frame too. We are here on the Euro Swissie. It's the daily chart. Every candle is 1 day, and you can see here this really nice green candle. It's massive, it's big, and before we had balance, you can see a lot of tiny candles, pin bars, spikes. This is what you focus on it. You want to see such a zone where the price does not move a lot and where you have a lot of pin bars and spiky candles. This is the first warning sign. And then if you get after such spiky candles, such a massive green candle, of course we draw then a demand zone, because this is demand if it goes up. So let's do this. Like always, we draw here our box here on the chart. Let's cover here the spike here and the lower spike here. So this is our balance zone. And if we check now here the lower end, because this here is then the entry and this is the stop loss. You see on the daily chart we have here a stop loss of 74 pips. So it's a bigger stop loss and you need of course more money or lower your risk with a lower lot size. So, and now we move this into the future. You can see this happened on October the 28th, and on the daily time frame you need really a lot of patience sometimes. It can even take weeks or months until such a zone will get retested. You can see here almost, but it began to go higher before. But let's do this in the future. Let's see how far we come. So, and that I can draw the box correctly, I make here a line on the high of this wick, because you can see it took a while and then finally it came back to our zone here. And then you can see it moved up here for 100 pips and then a second time for 200 pips. And you can see in this case we saw this zone, or has been created here on this day, end of October, beginning of November. The green candle came on November the 5th, and then we could draw here this zone, and the trade or the price came back on August 21. So this was October 2020, and it came back almost 1 year later. So in August 2021. So you can see you need sometimes really patient, or have to be patient, especially on the daily time frame. So if you have such a zone and you go only with the daily time frame, it is possible that you have to wait months. But you can see still it worked. It gave you pips. It was a really nice trade here for 100 max or here for 200 max in this case. It's not always the same on the daily time frame, of course. Sometimes it happens faster, but in this case you had to wait really months for this trade. And we don't speak of the weekly time frame, the weekly chart. Here it can take years before the trade comes back to such a zone. I show you now the opposite to the daily time frame, because I am very sure there are some scalpers out there and they wonder, is it possible to do the supply and demand trading on a M5 chart too? Yes, it does work, but you will get a lot of losers, because M5 is really noisy. You get a lot of trend changes based on this M5 time frame only. It's very noisy, but still you can catch some trades, but the win rate is lower. And you should really focus then on very strong zones. I have here an example for you. You can see here on the Euro Pound. In this case we had here this balance, and on M5 such a balance zone can be a little bit more tiny, because there's only some minutes in balance, and then it begins to drop maybe for 10 minutes. Like here you can see that here this balance for 1, 2, 3, 4, 5, 6, 7 candles. So more than 30 minutes in balance, and then we have 3 candles, so 15 minutes in imbalance. You can see it's the total opposite of the daily time frame we saw before, where we waited months. Here we talk about minutes. And of course you can try it here with a supply zone, that you draw here the box like we do always. Then we cover here again here this spike here and the high here, and let's go for it. It almost holds here. Let's see, it's very close to it, and you can see then this worked here. It was close. The stop loss is above our supply zone on M5. We would maybe add 1-2 pips more, and then of course you can do it. And we had here a stop loss of only 3 pips. We have a 3 pip stop loss, and you get here max of 25 pips. So if you have here a free stop loss of 3 pips, let's make it 5 pips, because 3 is really tiny. Let's make a 5 pip stop loss. Okay, this would easily hold in this case, and let's double it and say we have 5 pip stop loss, and we double it and go for 10 pips for target. Here 10 pips reached, then TP2, the target 2 is maybe 20 pips. We reached it here, and then it's out. But you can see even here we could make 30 pips. So from this M5 zone, it was really going down. We catched here a really good zone here, but you will find on the M5 a lot of examples where it would not played out so nicely. I want to show you some example now where maybe you think it's a supply or demand zone, but it's not. And then you maybe avoid losers. Like I told you in the minutes and before, we want really to see a good balance zone, so tiny candles, spikes. And if you here check, you maybe think this could be a supply zone, because we have this sudden drop here. It's really dropped. Big red candle. We're here on the hourly time frame, euro pound. And then maybe you thought, okay, I draw here a supply box. Let's do this just for fun here. Let's do our box here. And then the first problem we have, from where to where do we draw this box? Okay, if you say here I have spikes, okay, then you go with the spikes and with this high. But where do you see here tiny candles, pin bars, really tiny candles for maybe 4 or 6 hours? I don't see anyone here. But let's say you did this, we make it here from the high to the low of the spikes. Of course, you would catch some pips here in this case, because it came back and then it reacted a little bit. But you have then firstly a stop loss of 21 pips, and from here, from the entry, we had max 20 pips. So 1-to-1 may be possible here, but this is not a really it's not really a supply zone here, because we had no clear balance here before. This is very important that you check this, that we don't use zones which maybe then do not hold. And you can see another example. If you thought here maybe this could be here a supply zone because it begins here to drop, there is no balance before. This is obvious. We had here 2 big green candles, then 3 red candles. It's not here a supply zone. It's not. And this is here also a good example. We have this big green candle, and maybe you think, yeah, this is a demand zone. No, it's not. There is no balance before. Do you see here any tiny candle spikes? No, we don't see it. So it's not a demand zone. Yes, it's a really impressive green candle, but this green candle and the followed candles were only a stop hunt for this high here. Maybe they want to catch the stop losses placed here above this high. So this was only made to kick out all of the traders who are in this sell trade, and that they kicked out here with the stop loss, and then it was going down. This is a completely different trading method if you go for such stop hunts and want to go with the stop hunters. But this is not a demand zone because we have no balance here before. Now let's check this great example. We see this really impressive red candle, but do you see before tiny candles in balance? I don't see any. You don't see any. Okay, we agree. This is not a supply zone, and you can see here it does not react here later. There is no balance before and no little tiny candles to draw here. It's not a classic supply zone. And one more example, you can see these green candles here, and there's no imbalance before. We have no tiny candles, no spikes, no pin bars. and you can see it does not hold here. This is what you would do first, that you practice and you check for really the obvious spots. Don't chase for such zones. Only the zones you see with in a second or 2 seconds. If you look on the chart and you see under 2 seconds a zone where you think, wow, this looks really nice. We have balance, we have imbalance. Then you go with it. Don't chase here and look every candle. Is this one? No, it's here. So no, don't do this, please. Go only with the obvious zones, the zones you see. If you open the chart and you see the zone, then it's a good one. I want to talk a little bit about losers. Of course, this system will produce losers too. The win rate by supply and demand trading, I would say, if you practice it and you go really with the obvious zones, you can achieve 70 to 75% winners, but there are still 30% losers, of course. You can't avoid this. It's trading. If you have losers, please don't go and say this is not a good system, it's not a good method, I don't use it anymore. You have to focus with 30% losers. So say 70% are winners, 30% losers. And then it's important that you go maybe with targets like I told you, that you say not 1 to 1, but 1 to 2. That you say stop loss of 10 pips. I want to see a target with 20 pips. If I have a 20 pip stop loss, I go for 40 pips and so on. This means one winner you can make with one winner 2 losers and you still equal. So 2 winners allow you 1 loser if you go with 1-2 ratio, for example. I don't like this 1-3 and 1-4 ratios. Even supply and demand trading can give you such win ratios. But if you wait always for a winner with 1 to 4, that you say, okay, I have a stop loss of 10 pips and I want 40 pips target, then you will see again more losers, because it does not happen that often that you really get a trade with a 1-4 ratio. So better may make 2 or 3 targets, or like I showed you, that you move the stop loss behind from time to time, and then you are safe, for example. But avoid such big win rates with 1 to 4, 1 to 5. I know it's possible with supply and demand trading, but I don't use it normally. I go with 1 to 2, sometimes 1 to 3, but I like it too, to move the stop loss behind my trade, that I can manage it from time to time, and then I can wait how long it goes. Let's talk about entry methods. I showed you the method that you simply put the pending order on the lower or upper end of the zone. But this is of course a little bit riskier one, because if you put a pending order on these zones and then maybe we get a change of the fundamental news of this pair, then maybe you get a loser. So let's talk about how we can enter such a trade too. For this we go here with this example here. You can see we had here a balance. We had tiny candles, we have spikes, and then this big red candle. So it's a supply zone has been created here in the market. Let's make here our box, and we cover again here the low here, that little wick, and on the high side we would cover here this wick here, and then you can see it came back here into our zone with this pin bar, and from there on it was going down again. Here it's the hourly chart on the dollar yen here. So the one method to enter this trade, of course, is that we put here let's say here a pending sell order. Here on this day we saw clearly the supply zone has been created, and after this candle we could draw our box and we could place our sell entry, and then Some hours later, the price came back, triggered, and we had a nice winner in this case. The stop loss is above our box. I add always some pips, so I would not exactly place the stop loss on the end of this box, maybe some pips more of it. And then we have here the pending order with a stop loss of, in this case, 55 pips. And the max down move was 370 pips. Impressive. So if we decided here to go for 1-to-2 ratio, if we have 55 pips, so we need 110 pips to go for, and this would have been reached around here then. And then you could maybe make target 2, target 3, like I told you, or you would move the stop loss behind. So it triggered here our trade, the stop loss did hold here, and then it was going down. Let's say the price is here, then you would maybe move the stop loss to here. Then you wait some hours more, the price is then here, then you move the stop loss more down. Then price goes further down, is maybe here, then you move the stop loss here, and then it begin here a little bit to go up and down, and it creates here a little balance zone again, and then you maybe go deeper with the stop loss, and then you would have been taken out here. And in this case, with this money management method, you could make here around 300 pips of this move. And if you have a stop loss of, let's say, 50 pips and you get 300 pips, of course, this is a ratio where you can now face 6 losers in a row without losing your money, because it had such a big winner with this compared tiny stop loss. So you had a 1-to-6 ratio in this case by simply moving the stop loss behind. Don't do it too tiny. You should not, after every candle, change here the stop loss. You should wait maybe 3-4 hours, then you check again your chart, and then you move it to an obvious structure of the market, and so you go on, and then you could really get such a really big winner like here. And with a ratio of 1-to-6 in this case, like I told you, you could now make 6 losers in a row without losing money. And it's very, very rare that you get 6 losers in a row with supply and demand trading, especially if you focus on the strong zones. Is there a different entry method? Maybe you don't like such pending orders. Yes, you can do different. Let's say we have again here this drop, we draw our rectangle, and we don't place a pending order. We only want to get an alert when price comes back into this blue zone. We want to get an alert, a notification, maybe to our mobile phone or by email or on the desktop here. And after that, we decide if we want to jump into this trade or not. You can simply do this with the MT4. So we know exactly our zone, and we simply place an alert here. So we go here to the place where we want to have this alert. So around here, this is the end of this blue box. So we make a click with the right mouse button. We go to trading and then alert. We click on it, and then you can see here this little red line with the arrow on it. And now you can here move this alert wherever you want to have it. Okay, and if you make a right mouse click on this line, you can modify, delete, or disable it. Let's click on modify, and if we click on it, we get here this box, and here you can fine-tune here this alert. You can decide what alert you want to have. If you want to get a sound alert, how long does this alert gets valid, the expiration. So you can say, okay, if price comes not back after, let's say, 2 months, this alert should disappear automatically. Here you can place the exact value of the alert, so you have to check what price it is. For example, you could here draw a line. I'll show you this. I draw here a line. Let's say we want to get the alert a little bit earlier, that we don't miss it when it comes again close to this box. We have this line. We make a right mouse click, horizontal line properties, and then you go here to parameters, and then you see the exact value here of this line. With the right mouse click, we make copy, that we get a value here, and then we go back to our alert, which is this. We can delete now this white line. We go back to our alert, right mouse click, modify, and then we enter here with paste the exact value of the alert, so that we get exactly the alert when price comes back around this here. And of course you can here change different things. You can have a mail alert, you can get a notification to your mobile phone, whatever you want to have. Simply click on OK. For example, if I want it by email, I click here mail and click OK. And when price now comes back here, let's say we put the alert after this red candle. When price came back here, we would get an email by MT4 that the price came back to our zone. Then we open the chart and then we wait. In this case, we look for price action. You see, okay, it is very close here. The next candle makes this really nice pin bar, and then it begins to go out of the box again and begins to go deeper. And then you jump into a sell trade, because now it's confirmed. The box seems to hold, our zone seems to hold. It was going into our zone. We waited until it came out again. You check it maybe every 30 minutes then after you get this alert. And then when you see that the price action is good with this big red candle, which is an engulfing candle too, it engulfs the complete body here of this candle before. This is a good sign, and then you jump into here your sell trade. Of course, you have a later entry because you wait for confirmation, you wait for price action, but still I use this method the most. I use the pending orders too on really strong zones and when the fundamental news are really good, but on the other days I go with this entry method. I wait for the alert and then I wait for price action, and if I see that this zone holds and it begins really like here to go down again, then I open my sell trade. One more thing what you can do as extra confirmation or checking for price action, that you change the time frame. So we stay at the same system. We wait for an alert that the price comes back here to our zone. And then let's mark the position when this happened. You can see with this candle it came back to our zone. I mark it here with this line. And when this happens, then you switch to the M15 time frame, for example. If you're on the H1, you switch to the M15. Let's check here, M15. Let's see where our entry is, or our alert. You can see here with this, it was going here in our box. We're on the M15. And then, for example, you would check candle by candle, and then you can see, okay, it was going out. Here it makes a little retracement. And it retests here again on the M15 this box. A really good sign. Then you could draw here a trend line. For example, oh, it's a black one. You don't see it good. Let's make it to yellow, for example. With the lower ends of these two candles, which is the retracement here, you make this trend line, and then you wait that this trend line gets broken on the M15, and then you enter this trade. This is also a way to do it if you want to have the extra confirmation on the lower time frame, which is really good that you wait. Of course, a little bit later the entry compared to our pending order if we lay it here, but still this is really good if you wait on a lower time frame and you check for price action. This is a really good sign. It dived here into our zone, it came out again. This candle retests here with the spike again this upper end of our supply zone, and from there on it is going down. So if you go to the lower time frame, you see more what is going on. You can fine-tune the entry, and if you don't see such a behavior, for example that after this candle the price goes again in this box and goes a little bit higher and then goes a little bit lower and higher, then maybe you skip this trade. The perfect supply and demand trade, the really perfect supply and demand trade is that the price comes back into our zone, leaves the zone and comes not back. Like here on H1, where we see 2. This is what really looks nice. What I like even more is if we had not this candle here, and after this little touch of this box, it goes down from there. This is even more better if we don't have such a deep dive into our zone. Deep dive into our zone is riskier, but this really nice pin bar is a first sign that this zone is too strong that buyers come through so that we can go into a sell trade. But the really optimal, amazing, great retest of the zone is that it only dips a little bit here, our zone, and from there on it goes down. This is the trade I really would open, and I would go for it, especially if the stop loss is not too big. And then you wait simply what happens next, and maybe you move the stop loss behind like I showed you. This was the basic stuff about supply and demand trading. I hope this video helped a lot. I make more parts of this series of supply and demand trading. The next part I want to show you how you can draw and get these boxes completely automatically by an indicator, because of course you need some time. If you have, let's say, 28 pairs and you have to check for all of these pairs 3 or 4 time frames for supply and demand trades, it can take a while. And for this we have the supply and demand indicator, which do this hard work for you. And how this indicator looks like, you can see here. This is the supply and demand indicator from Metagrid, which I coded, and this finds automatically all the zones. You can see here on the Aussie Kiwi, here on the 4-hour time frame, 4-hour chart, and you can see it found here this supply zone. It does a little bit more, as I showed you. It also calculates the volume which is behind of every bar. So it does not only look for these tiny candles and these drops, it also checks what volume is behind of every candle. And then sometimes it finds additional zones which you would not find with the naked chart. But basically it does completely the same, but completely automatically. And you can see here we had this nice supply zone drawn. We had balance before. We had some spikes on it, and then we had 2 red candles here on the H4, and price came back into our zone. And this is such a retest of the zone I like. It dipped a little bit in, and then it began to drop again. And then you could here take this trade. But it's not only an indicator which shows here one time frame beyond the H4. If you change the settings of the scanner, it can show you on one chart all of the supply and demand boxes. And in this mode it looks like that. You get then more boxes in different colors. Here, for example, the white box stands for H1 demand and supply zones, the yellow one for H4, and you can see on one chart any of these zones from all time frames, and then you can see it worked here, it worked here, it worked here, it worked here. So really nice stuff. It goes up for every time frame. You can see here on the weekly chart, and this is the last thing I want to show you here on the indicator. The indicator found here this really large weekly zone. I don't think we would trade it this way, but still you can see it found here this zone on March 2020. It came back to the zone in October 2022, so in this year, and it reacted really nice based on the weekly. Of course, it's a lot of pips, it's a weekly chart, but after here, if we had placed here a pending order, now we are here again over 400 pips here in profit. So it works here on every time frame. You can see if I switch it through. I will show you this indicator in the next part of my series about supply and demand trading, because this helps a lot. You can change a lot of the settings. You can customize it like you want to have, what time frame you want to see on the multi-time frame analysis, if you want only one time frame to see, if you want some time frames to see, or completely automatically calculated. And you can even tell here the scanner that it should the indicator that it should scan for specific signals for supply and demand trading. This I show you in the next part. I hope you learned a lot. My idea is that you maybe check your chart, that you begin with supply and demand trading, that you practice it, that you look for these zones, you draw your own zones, that you understand supply and demand trading with your own zones, that you understand how they get developed and how they play out. And then you can go the next step, maybe that you use an indicator to get these zones drawn, that you have a little bit less work, and then you can focus completely on supply and demand trading. Have a nice day and goodbye.